consumer stocks had gone through the roof. They've been, they were in their last parabolic stage from a move that started in 1982, because in 1982 inflation peaked, and that was the beginning of the buy the steady growers, buy the kind of the steady growth stocks, and get out of inflation hedge stocks. And I made a lot of money by understanding that that's the time you make the switch, is when inflation's at its peak. You buy the stuff that's anti-inflation.
Are we in a melt up? It's going to result in a crash, perhaps in the next year. Then we're going to have a little bit of a euphoria where things may be great and really rise up, sadly, to come within maybe 10 years to a crashing end. One, do I have that right? And even if I had it right a year ago, what have you adapted? And I'm making it a little too complicated now, but is AI going to change some of those, that 1, 2, 3, 4 assumptions that I noted?
Yeah, I don't think so. My assumptions are still pretty much the same as when we talked last time, a year ago, if it was. I do believe that, as I said, we're going into a secular top here, 44-year secular top. And after that top, and by the way, when I talk about a global bust, it refers to the economy and the financial system. And the reason I call it a bust is because it'll be accompanied by, I think, some big bank failures, some major financial crisis, similar to what we saw in 2008, but maybe worse. So people hear bust and they think I'm referring to the stock market. No, bust refers to the economy. Bear market is what will accompany it, that refers to the stock market. So I believe the bust and bear market will follow this last run up. Like I said, I think it's next year, but I certainly have had to push this out year by year by year because I thought it happened sooner than this. So, guilty as charged in terms of that. But I'm lost my train of thought.
Well, whether it's the right move or not, the bust, as you describe it, potentially banks, and let's go with corporations important to our ecosystem. Let's say it is a bank. Let's say it's, I'm throwing it out there. We have two massive private companies in AI that are among the largest companies on earth, OpenAI and Anthropic. I don't see, whether I like it or not, I don't see the US government allowing companies like that to fail. AKA they're too big, or maybe their perception too important to fail.
Yeah. So my whole thesis for a global bust is predicated on the fact that we have leverage in the system, and I'm talking about a global bust, so this is worldwide. Leverage in the system that it blows away what we had going into 2008, 2009. We are so far more leveraged as a world economy and a world financial system than we were back then. We've never been, and that was way off the charts. So we've never been here before. And leverage works great on the way up. It enhances. But as we just saw with our hedge fund friend,
Aschenbrenner, yes.
Yeah, it goes the other way, just maybe even faster. So that is kind of a microcosm of what I think we'll see in the world economy, the world financial system, in terms of a pretty simple thesis that once the economy heads south, that leverage is just going to take it far beyond what we would normally expect. And it's not a bank or one place. There'll be a lot of places where the leverage will show up as a problem. We just saw the hedge fund situation, but it's pension funds that are loaded up with private equity and private credit. It's banks overseas. China. I just saw a video on my feed today. Somebody put up that was about a big project in Malaysia, and these two guys, took it upon themselves to go discover what this place was, and found it was empty. It was multi-billion-dollar project, and there was nobody living there. It was high rises. They had a big mall to go with it that was marketed as this great shopping center, and it was all they had pictures on the glass, on the storefronts, and no storefronts were active. They went into the only restaurant that was available in the whole so-called new city. Um, and they went in and sat down, and there were like 8 other people in there. As soon as they sat down, those 8 people got up and walked over to their table. They were all part of the staff. There was nobody there, but it turned out it was a China project. And then China pulled the plug because of all the problems in real estate in China and stopped allowing. It was meant to be for their people to invest in Malaysia in a project, and they pulled the plug on it and don't allow them to invest it. So it's sitting there 2 years empty, multi-billion dollars, and you can probably multiply that by many other projects. So the point is, it's not just the U.S., it's not just Europe, it's not just Japan, it's not just China. It's worldwide. We have this way over leveraged system, and maybe I'm premature, and it's going to be able to be pushed out some, but I think it's coming this cycle. Whatever, whether it's months away or a year away, I don't know. I keep saying I think it could happen pretty fast.
Steelman, the bulls, real earnings, real productivity, better margins than 99. Make the case this is maybe like 95, then of course I'll let you kill it.
Yeah, earnings have been through the roof. When you look at what the AI earnings are, amazingly. But what we're hearing now is that for this quarter, you're starting to see the laggards, the kind of more conservative companies are starting to see their earnings turn up in a nice way, so that you take out AI, because everybody thought, this is just AI or this is just semis. You take that out, and you're still getting something like 13% earnings growth out of the so-called boring stuff. So we are in an earnings cycle that's unbelievable. Some of that may be AI already, but a lot of it is just good old-fashioned cost cutting, hunkering down, and being able to have healthy profit margins in spite of oil, in spite of all the doom and gloomers out there talking about how this was all going to be a train wreck. So that part is there. In terms of being 95, this is far too frothy. I remember 95 because I had made the case in the early 90s, like 93, 90, 92, I guess I was at an insurance company running their active equity department. And I, again, in my contrary way, there was a chart circulating back then that showed the relationship between consumer stocks and capital goods stocks. And of course, capital goods includes technology. And it was at all-time lows. Capital goods, consumer stocks had gone through the roof. They've been, they were in their last parabolic stage from a move that started in 1982, because in 1982 inflation peaked, and that was the beginning of the buy the steady growers, buy the steady growth stocks, and get out of inflation hedge stocks. And I made a lot of money by understanding that that's the time you make the switch, is when inflation's at its peak. You buy the stuff that's anti-inflation. So in 1982, I made that call. In 1992, I made the call, just the opposite one, of saying these growth stocks are way overvalued. They're at their cycle peak, secular peak, if you will. And it's time to load up on capital goods. So my portfolio at the insurance company was very concentrated in some old industrial capital goods, the Caterpillars of the world, the Deeres of the world, but also a big chunk of semiconductor and semiconductor equipment companies, and a couple other tech companies. So that over 50% of my portfolio was tech at a time when nobody wanted tech. You could buy Texas Instruments, which was in my portfolio at that time in 92. You could buy it basically because a lot of their contracts were government. When you backed out the government funding and stuff, you were buying it at book value. And you were buying things like Teradyne. I had Teradyne and KLI and KLA, and you're buying these things flat on their backs in the next 3 or 4 years into that mid 90s, 95, 96. they started slow. I was in there a bit early, and the consumers had one last hurrah, so I was underperforming. But then when they started, they took off, and by '95 they were already moving up pretty nicely. The portfolio I had outperformed the S&P in the 90, I think it was the 93, mid 93 to mid 95 period by 5,000 basis points, 50%.
Oh my
And,
God.
the S&P in that time was flat or not very far, and these stocks were up 50%. So, and that was the whole portfolio. So it wasn't just the semis. Um, so I would, and then from there, or the rest is history, because the real move came in the late '90s, as you know. I mean, the whole .com story. So '95 was very early in that. We're not anything like that today. I think the conditions today are much more like '99, if not 2000. So, um, I think '95 was a very early time in tech land. Now we're probably later. Now that being said, I'm looking at it cyclically, not secularly. There is obviously AI is probably going to have a shakeout in the bust, but that doesn't mean it's over. There's probably a long, AI investment cycle and AI cycle, beyond the bust. But it's not going to be a straight line. There's going to be probably in the next year a shakeout.